Everyone, welcome to Chapter 2, which is Audit Quality and Pre-Engagement Activities. So first of all, audit quality. So audit quality is a big risk these days, and it's in the media a lot because of allegedly declining audit quality because of we mentioned a lot before about the efficiency of audit. So in order to increase profit margins, accounting and audit firms have been trying to make it as efficient as possible by reducing the labor cost and the amount of time spent on audits. So whilst there is something to be said about making it efficient, that doesn't mean you need to cut costs. And given it's something that really you only identify when something goes wrong, for example, you could cut costs and no one would know if it's a good company. But if as soon as a bad company hits, for example, Wirecard, and you find out things in the news like EY not even requesting the bank statements, that's when it becomes public knowledge. So, and this is combined, this is probably driven by a few things. One of the key reasons is declining audit fees as well. So there's a lot more audit companies coming on the market being competitive, and also customers, i.e. the companies producing the financial reports, are adding a lot of price pressure to get the fees down. So in order to retain those profit margins, the audit firms do have to actually cut audit quality. So it's a difficult issue because it is such an important cog in the financial system. So this is what we'll be dealing with today. And there is a section in the IASB about what constitutes audit quality. So what are the key elements that create an environment for audit quality? So the things that are defined in this framework for a quality audit is it's likely to be achieved by an engagement team that has, number one, exhibits appropriate values, ethics, and attitudes. Number two, sufficiently knowledgeable, skilled, and experienced, which is hard when you're often dealing with new graduates who've just come out of university. It's more to do with the partner making those decisions on the job. And sufficient time to perform the audit work, so making sure that's not rushed and back to back and so forth. Number three, applies a rigorous audit process and quality control procedures that complies with law, regulation, and standards. Number four, provides useful and timely reports. Number five, interacts appropriately with relevant stakeholders. So enforcing audit quality. So I mentioned before, how do you actually know that people are doing it? So ASIC, the Australian the regulator of the Corporations Act, also has some ability to enforce audit quality in Australia as well. So what they do is they regularly monitor audit quality by conducting periodic inspections of a sample of completed audit engagements during a given inspection cycle, which is 12 to 18 months. And once the inspection is complete, the regulator issues an inspection findings report to the auditor. And the possible outcomes could be requiring the auditor to perform relatively minor remediation of the audit documentation, requiring additional audit procedures to be formed, restatement of the financial statements, and a new audit report. So the regulator also publishes a report summarizing the finding from all their audit inspection findings over the inspection cycle. So recent audit regulator findings, you're unlikely to get a question on this in the exam, but some of the key recommendations that they've found of areas of improvement by audit firms is accounting estimates, including fair value measurements. So they're saying that audit firms are not appropriately assessing sufficiently the reasonableness of management assumptions or exercising professional skepticism in considering contrary and inconsistent evidence. So for example, the auditor is saying, okay, so what's your value on your current properties that you've got there, which are listed at fair value market? And the client saying, well, here's our assumptions, this is how we calculate it. And the auditor saying, yep, okay, that's fine, ticking the box. Because we're going to get this audit done, as opposed to saying to them, okay, what are your assumptions behind all of these? Sitting down with management, asking them, and then when they start saying, our assumption is that we're going to have growth of 9% a year, the auditor should be saying, well, hold on, that 9% a year growth is pretty unrealistic, especially when we're in the middle of a likely declining economic conditions. Are you sure those are appropriate? We recommend adjusting this probably to 2 to 3%. That's a difficult conversation to have, especially if the person you're auditing is your client, the person paying your fees. Generally, people don't want to annoy the person who's paying their bills, so they might just avoid these difficult questions. But it's something that we need to do as auditors. Number two, testing internal control. So a lot of the time in practice, audit firms are just focusing on analytical procedures. So actually recalculating things, checking that number and so forth. But internal controls is such an important part because if you can make sure the controls are working, then it gives you so much more faith that the underlying content is correct. I gave the example before about testing AP controls. For example, you might be putting through a fake invoice yourself just to see if it gets accepted. And if it is accepted, you're like, hold on, this is a huge area for fraud. There's a high chance of fraud occurring. If this can go through the system, someone else has probably figured this out, and we then need to look for it. So ASIC is saying that it needs to be more testing of internal control. Point 2 is talking about what are the things within the audit firm that should be done to drive quality control. So these are the things within the control of the company. So number 1, leadership responsibility for quality within the firm. So leadership sets the tone at the top. Number 2 is relevant ethical requirements. So making sure that the firm is following the ethical standards. Number 3 is acceptance and continuance of client relationships and specific engagements. So ethical leaders who promote audit quality create a firm that considers the integrity of its clients and only accepts work when it has qualified and able staff available to do the work properly. So part of audit is actually rejecting certain engagements if it doesn't fit in with the integrity of the audit process. So number 4 is human resources. So audit firms sell audit services. So the quality of those auditors is determined by their competence, their capabilities, and the commitment to the ethical principles of the firm's personnel. So part of that is having the right people and making sure your skill base is appropriate. So you don't have too many people at the top. You don't have too many juniors doing work that needs to be done by experienced people. So audit firms generally have partners who are 10 plus years working there. Managers 5 to 10 years. Seniors 3 to 5 years. Juniors 0 to 3 years. And then number 5 is engagement performance. So ISQC 1 sets out principles to guide audit firms in designing policies and procedures that ensure consistency in how their personnel perform engagements. Okay, so in any given engagement, there's generally a certain team structure, as I mentioned before. So you're going to have the audit partner in charge, and they're ultimately responsible for the audit, and they sign the audit report. So anything that goes wrong is going to go back to them. And they're the one leading in terms of identifying what the risk is, what the materiality is, and so forth. We need their professional judgment to help make those decisions at the highest level. Next is engagement quality control reviewer. So they're basically a person who's listed to audits of listed entities and others. The day-to-day management of the process to a manager who coordinates the audit and supervises the seniors in audits as they execute audit procedures. And their responsibility is for the detailed supervision and coaching of audit juniors. That's sometimes delegated to audit seniors as well, who are on the engagement. And then you get to the core audit team, who are going to be doing the bulk of the work. So for complex issues, the audit team is required to consult a specialist in a particular area. For example, technical accounting issues, because as an auditor, you're not expected to know all the detail of every single area, but you are expected to get it right. So sometimes it's about finding the right person for the right job, and that might be about finding a different person in your firm. So technical accounting issues, audit methodology issues, audit opinions, and other specialists. You can get a tax specialist, valuation specialist, technical accounting, audit methodology specialist, IT specialist, fraud specialist. So it's about bringing in the right person for the right area. So in terms of allocation, supervision, and review of audit work, so the overriding principle from ISQ1 is that areas at greater risk of material misstatement are audited by more experienced team members. So basically what I said before about is you identify where the key risk area, and where those areas are, or where you find risk in a certain area, you need to allocate more resources. And those resources are more time, more work, and more experienced people looking at this. You don't have your junior person focusing on the most complex areas. So most of the routine work is done by the juniors, but if there is a high risk area, it should be done by the more senior staff. Also, audit work needs to be reviewed by someone more experienced than the person who performs the work. And generally you have this tiered level of reviews for the first level reviewer, second level reviewer, and so forth. Now, offshoring of audit work is another thing that happens. It's basically firms have outsourced basic audit work to offshore service centers, like you might have a team in India or the Philippines and so forth, just to help get through that core grunt work. So where that work is actually outsourced, the core team is still responsible for all of the quality of the work still performed. The same quality of work, same quality controls still applies, and all work must be appropriately monitored and reviewed. And the offshore team must be properly experienced and have the appropriate expense. The monitoring, so there must be documentation and communication of system of quality control. So ISQC1 requires firms to prepare documentation that prepares evidence that they have quality control systems in place and that they are functioning according to requirements. So now we're getting on to the important parts of fundamental principles of the IESBA Code of Ethics. And this is the approach to an audit engagement to ensure everything is done in an ethical and compliant manner. Question, and it also comes up in the online quiz as well. So it's really important that you understand what each of these mean, and that when you give an example question, you're able to identify what the key issue is in the question for each of these. So we'll spend a bit of time going through each. So number one is integrity. So it's to be straightforward and honest in all professional and business relationships. Number two is objectivity, to not allow bias, conflict of interest, or undue influence of others to override professional or business judgments. So a common one is the fact that there's the client and auditor relationship where the client is the person you're auditing and paying your fees, and the auditor is required to ask the difficult questions. So often this is a key risk, objectivity, as a result of that relationship. So we need to overlook that and ignore that. Just make sure that's not influencing the outcome of the audit. Number three is professional competence and due care. So it's to maintain professional knowledge and skill at the level required to ensure a client or employee receives competent professional services. So it's basically making sure that you're hiring qualified people, that you've got the right team mix, that you're keeping up to date with all the relevant standards and so forth. Number four is confidentiality. So it's to respect the confidentiality of information acquired as a result of professional business relationships, and therefore not disclose any information to third parties without proper and specific authority, unless there's legal professional right or duty to disclose. So it's basically, if you're dealing with client data, for example, making sure, you might have another client where you're doing consulting work, but then you're auditing their competitor. So, and your other client might be saying, what's happening with that other client. So it's important that you don't disclose any confirmation, you don't let that influence your decision or any actions in between. Make sure that the two are completely separate. And lastly is professional behavior, to comply with relevant laws and regulations and avoid any conduct that discredits the profession. So for example, you might find something which is a material risk in your audit, and maybe to keep the cost down, you might say, let's just ignore that and just say that we didn't see this or something like that. So you don't have to do any further work on it. That would obviously be against the professional behavior. It'd probably be also against the integrity principle as well. So the next thing we're going to be talking about is threats and safeguards. And again, this does come up in exam questions and online quizzes as well. So it's identifying where the threats are to each of these principles. So for example, self-interest. So it's the threat that a financial or other interest will inappropriately influence the behavior, accountant's judgment, or behavior. So an example of that might be, here we go over here. So the temptation to accept gifts offered by a client. So gifts are a strong no in an audit. So even if it's very small, the idea is that a gift to an auditor can be seen as a way of getting the audit cleared a bit faster, or to look the other way, or just do the client a favor or something like that. So you're not allowed to accept gifts in an audit. Or it could be the thought of losing a recurring client, or it could be loans to or from an audit client. The next threat is self-review. So the threat is that the professional accountant will not appropriately evaluate the results of a previous judgment, etc., where the accountant will rely when forming a judgment as part of a current service. So whenever an accountant does the same work, it needs to be reviewed by a senior auditor, and vice versa. When we're relying on work that we're auditing from the client, we need to make sure that the client's work has been checked by someone else as well as part of the process review. So here's some examples here. A member of the engagement team being or having recently been a director or officer of the audit client or employed in an executive position by the client. Next is advocacy. So this is the threat that a professional accountant will promote a client or employer's position to the point the professional's accountant objectivity is compromised. For example, promoting shares in a listed audit client, acting as an advocate on behalf of an audit client and resolving disputes with third parties. Next is familiarity. So the threat is that due to a long or close relationship with a client or employer, a professional accountant will be too sympathetic to their interest or too accepting of their work. So this is accepting preferential treatment unless the value is clearly insignificant. Close or immediate family relationship with the director or officer of a client or with an employee who is in a position of influence over the subject of the engagement. And then finally is intimidation, the threat that a professional accountant will be deterred from acting objectively because of actual perceived pressures, including attempts to exercise undue influence over the professional accountant, e.g. being threatened with dismissal or replacement in client engagement, being threatened with litigation, being pressured to work, to reduce the extent of work required in order to reduce fees. How the auditing framework helps to mitigate some of those risks that we mentioned above before, both in terms of the fundamental principles of ethics and secondly, the threats and safeguards to having an appropriate audit actually occur. So the first one that the IASBA code attempts to address is objectivity, and that requires an accountant to identify whether there are any threats to their objectivity from having interest in relationships with a client or its directors or officers or employees. This is an important thing that you'll go through in any audit process is identifying which listed shares do you have, because so you're not influenced to actually, for example, you might earn $100,000 in one particular audit listed client. You then put on the audit. You don't disclose that you own $100,000 in shares. You then find something during the audit, which as an auditor, you'd have to issue a bad opinion about the company, which would also impact the stock price of that company. So you might be encouraged to not report that information or not identify that as a risk during the audit. So this is important to actually disclose all these things so the partner or whoever is in charge can actually identify those potential risks and then get someone else on the audit engagement. So when you're on an audit, you need to be independent, as we mentioned before. But independence can be defined in two ways. So number one is independence of mind. So that's the state of mind that permits the expression of a conclusion without being affected by influences that comprise professional judgment. That's basically you yourself don't have any of these, threats to your own judgment. And then there's the second type, which is independence in appearance. So you might have a clear mind. You might own $100,000 of shares in a particular company, and you might have a clean mind. You might go through and do the right thing and say, I'm going to report all of these risks during the audit no matter what. But that's not good enough because you also need to appear independent as well, because as a third party, I don't know that you have a clean mind. I don't know that you're an ethical person. All I see is that you own shares and that most likely I'm going to come to opinion that you may be prejudiced against a particular company or for a particular company. So you also need to appear to all external parties that you're objective. And that means if you have shares in this company, you need to take yourself off the engagement, or one of the partners needs to put someone else in there instead of you, as one example, regardless of how ethical you are as an individual. This is called a safeguard. So if an accountant determines that there's no appropriate safeguards available or that the appropriate safeguards do not reduce the threats to an acceptable level, either the circumstance relationship that creates the threat must be eliminated, for example, taking the person off the audit or terminating a relationship, or the accountant should decline or terminate the audit engagement. So this is worst case scenario, is that if you can't actually reduce your threshold, you can't reduce the threats to an acceptable level, you can't accept the audit engagement. That's it. So you actually have to turn down audit engagement sometime so that the checks and balance of the auditing process and the financial system still work. So on top of just the normal ethical framework for IASBA, public interest entities, which we talked about before, is the ones that are actually mandated to have audits and regulated by ASIC and so forth. They have a few extra independence provisions, so they must include PIE include all listed entities, any entities defined by regulation and legislation as a PIE, and any entities for which the audit is required by legislation to be conducted in compliance with the same independence requirements that apply to the audit of listed companies. So there's additional independence provision required in these situations. It doesn't go into detail as to what those additional independence provisions are, but just note that there are additional requirements. Okay, so moving on, long association with audit clients. So understanding the audit client is fundamental to audit quality. However, the long association of an audit personnel with certain audit clients can adversely impact the auditor's objectivity, professional skepticism, and create familiarity and self-interest threats. So quite a few of those things that we touched on above, in particular the familiarity threat. You might have a good mate who's the CEO, and you're less likely to actually do anything about if you see any fraud and so forth. The key safeguard to prevent this threat is actually legislated. So an individual must not be a key audit partner for more than 7 years. So basically, you need to keep rotating your audit clients to prevent you developing that relationship. To agreeing the terms of audit engagement. So we're more focused on the pre-engagement section of this chapter now, whereas previously what we were talking about before is audit quality and making sure that the audits that we're doing are of high quality and satisfy the standards of the framework. Now we're moving on to more of the process. So what are the first steps of the audit process? So the number one is actually agreeing on the terms of engagement. So number one, what is going to be done? What's the scope? Who's going to do it and when? And all of this is detailed in what's called as an engagement letter. So this is a document which is set out all of the key terms of the transaction to avoid any misunderstanding. And the key things it contains are the auditor's acceptance of the engagement. Now keep in mind, as we said before, is auditors should not accept the engagement if there's any independence risks and they can't mitigate them with safety thresholds. Number two is objective and scope of the audit. So what are they actually going to do? What are they trying to achieve? Where are they going to look? Where are they going to look? And so forth. Number three, extent of the auditor's responsibilities to the entity. So what is the auditor actually responsible for? Number four, what is the form of any reports? Okay, so the preconditions for an audit. So number one is determine whether the financial reporting framework is to be applied in the preparation of the financial statements is acceptable. So this is not an issue for entities reporting in accordance with legislation, as these would be under the Australian accounting standards, but there might be a different framework that you're actually applying it to. Seems unusual, but it's possible. Okay, number two, next is obtain agreement from management that it acknowledges and understands it's responsible for the preparation of the FinStats, the internal controls, and the providing the auditor with access to all information, because there's no point going through an audit process if the management denies their responsibility or their role in the preparation of FinStats, saying, oh, I didn't do this, it was someone from the finance, or this is out of my account. At the end of the day, your company's names are on the financial statements. You, as a director, you're signing off on them. You are responsible for these. You're also responsible for the internal controls of the company. They can't just say, oh, that's my CFO's job, he's meant to do that. Again, the company is responsible for all controls and making sure that the controls are in place to prevent misstatement and fraud. And then number three is providing the auditor with access to all information. So it's all good and well if they're agreeing to everything else, but if they're not going to give the information the auditor needs to check everything, then they can't do the audit and then they're going to issue a negative opinion. Okay. Who the auditor should communicate with. The auditor is required to determine who is the most appropriate person to communicate with. So the general concept that we deal with audit as is those charged with governance, or TCWG. They're the people within the organization who are responsible for the strategic direction of the entity and the obligations relating to the accountability of the entity, including overseeing the financial reporting process. So for example, the people who are accountable for the entity are the directors of the firm. They can actually be held personally responsible, even if it is a listed company, even if it is a company with limited liability. Directors of a company under ASIC can actually be held personally accountable if there is instances of fraud and a few other situations. So part of that is identifying, okay, so who are the people who are managing those obligations, that strategy, sometimes on behalf of the directors, sometimes on behalf of the entity. So who do we have to speak to? So it might be the CFO, could be lower level management, could be the board of directors, could be the chairman, could be the CEO, and so forth. Typically, it's the board of directors because they're the ones at the end of the day who are going to be held responsible for if anything goes wrong. So yeah, they're usually the first port of call, but they may redirect you to other people within the organization. So audit committees. Larger entities usually have an audit committee, which is a subcommittee of the main board. So the audit committee is charged with the task of assisting the directors to meet their responsibilities relating to the integrity of financial reporting. So audit committees have an important role in overseeing external audit and audit quality. Where an audit committee exists, it is best practice to invite the auditor to attend the meetings of the audit committee and for the chair of the committee to liaise with the auditor periodically. The audit committee should also meet with the auditor without management being present so that there's no undue influence at least once a year. In Australia, the listing rules of the ASX require that companies of a certain size have a properly constituted audit committee with a sufficient number of members who are independent and have sufficient technical expertise in financial reporting to be able to perform their roles effectively. Companies in S&P All Ordinaries Index have an audit committee that complies with the recommendations set by the ASX Governing Council. So this committee must comprise of at least 3 members, all of whom are non-executive directors, and a majority of whom are independent directors. It must be chaired by an independent director who is not the chair on the board. These companies also have disclosure requirements relating to the audit committee. The areas of responsibility are financial reporting, external audit, risk management, internal control, internal audit, compliance with laws and regulations, and ethics. So examples for each financial reporting is determining the appropriateness of accounting policies, appointment and remuneration of auditors for external audit. Risk management is identification of risks and maintenance of risk register. Number 4 is internal control, which is ensuring effective controls are maintained. Number 5 is internal audit, which is overseeing the response to internal audit recommendations. Number 7 is compliance with laws and regulations, which is monitoring compliance with financial reporting regulations. And number 8 is ethics, which is implementing and maintaining whistleblower hotline. So what should be communicated? So matters to be communicated to those charged with government. So this is from the auditor to those charged with government, which could be the audit committee, at the planning stage of the audit. Number 1 is the auditor's responsibilities in relation to the financial statements audit. Number 2 is the fact that the audit of the financial statements does not relieve management or those charged with governance of their responsibilities. And finally, the plan, scope, and timing of the audit. Cool. And that is the end of Chapter 2, Audit Quality and Pre-Engagement.